Once we record the transactions for a business for a period of time, we want to provide information about those transactions to users. And we cannot give the users those detailed transactions. So we have to provide them with some summary information. And that summary information is provided in the form of financial statements. And in accounting, we have four basic financial statements. We have the income statement, followed by the statement of retained earnings. Then we prepare the balance sheet. And finally, we prepare the statement of cash flows. You need to have a very good understanding of what is included in each of these statements. We will not be doing the statement of cash flows until chapter 12, but I am going to walk you through the statement of cash flows that we've prepared for Red Company. So I'm going to give you an example of an income statement, statement of retained earnings, and a balance sheet for Red Company based on the transactions we recorded for Red Company a while ago. So the income statement is the first financial statement that is prepared, and it essentially tells you about the profitability of a business over a period of time, such as a month, a year, 6 months, etc. So essentially what is recorded in the income statement is your revenues and expenses and the resulting net income or net loss. So here is an example of an income statement. The title or the heading says who, what, and when, which is the name of the company, the name of the financial statement, and the period of time it is prepared for. So an income statement is prepared for a period of time such as a month, 6 months, a year. And so in the case of Red Company, we are showing the income statement for the month of May. In the body of the income statement, we record the revenues and we record the expenses and then the resulting net income or net loss. So if you compare the revenues with the table that we prepared for Red Company in the video that you should have just seen, the total revenues are 28,000 and then our total expenses were 5,500, which resulted in a net income of 22,500. So expenses are deducted from the revenues to arrive at net income or net loss. This net income will next be incorporated into the statement of retained earnings. Essentially, you already know how to prepare the statement of retained earnings because the statement of retained earnings explains the changes that have taken place in retained earnings over a period of time. And we already know what causes retained earnings to change. And one item we know that causes retained earnings to change is net income. So in the actual statement of retained earnings, which once again has the heading of who, what, and when, we start off with the beginning balance, which is as of May 1. And what you notice is there was no balance. And the reason for that is that Red Company was not formed as of May 1, and as such it did not have a beginning balance of retained earnings because there was no past income that we had. To that beginning balance we added the net income, which comes from the income statement, and then we subtract out dividends, which if you look at our transactions for Red Company for May, dividends of 2,500 were paid, and so the resulting ending balance of retained earnings is $20,000. So this net income of 22,500 minus the dividends caused retained earnings to go up to $20,000. Next is the balance sheet. The balance sheet is nothing but your accounting equation assets equal liabilities plus equity in a nice fancy format. So the balance sheet essentially describes the financial position of a company, importantly at a point in time or on a particular date. So a balance sheet has a heading, who, Red Company, what, balance sheet. And instead of saying for the month of May, you say it is as of May 31st, 2013. Because assets keep changing, liabilities and equity keeps changing, we have to report these as of a particular date. We have to report their balance as of a particular date. So we have assets on the left side, if you think about it being divided into two halves, this is the account form of balance sheet. And so we have assets on the left. And, if you go back to the table that we had for Red Company that we created, you saw cash was 37,000, supplies was 1,000, accounts receivable was 8,000, and equipment 15. And that gave you total assets of 61,000. On the liabilities, we had accounts payable of 1,000, notes payable of 15. That made your total liabilities 16. Equity in the form of common stock was 25. And then retained earnings balance, which came from the retained earnings statement, is 20,000, giving us total liabilities and equity of $61,000. So this is how you prepare a balance sheet. So on the income statement, we have revenues and expenses, and on the balance sheet, we have assets, liabilities, and equity. And so there is no crossover of the items that go within these financial statements. The statement of retained earnings is essentially a link between the income statement and the balance sheet. And these financial statements have to be prepared in the order that I just mentioned. The last financial statement is the statement of cash flows. Now, I told you that we are not going to look at the statement of cash flows in detail until chapter 12, but I just want to tell you what the statement of cash flows is and walk you through it somewhat. So, a statement of cash flows essentially explains the balance of cash on the balance sheet. So, how did we get $37,000 of cash? That is what the statement of cash flows explains to us. And a statement of cash flows is broken down into three categories: cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. And so within each of these categories, we list inflows and outflows of cash, and that helps explain to us how we got the balance of cash on the balance sheet. So this is the same amount that you saw as cash on the balance sheet. Here I just have a simple problem for you to do using the accounting equation, and it's really more maths than anything else. So they've told us that during the year, Finesse Company's assets increased by 28 and were 214,000 at the end of the year. Liabilities decreased by 20,000 during the year and were 63,000 at the year end. And we have to determine the increase or decrease in equity during the year, as well as the beginning and ending balances of equity. So really, we are given some information about assets, some information about liabilities, and nothing about equity, and we have to determine equity. So the best way to solve this is to set it up in the form of the accounting equation. And so what I have here is whatever information was provided to me in the problem, I have recorded it here. For example, assets increased by 28 and were 214,000 at the year end. So I've recorded it in this fashion. Likewise for liabilities. And so now that we have these components, I can find out beginning assets and beginning liabilities. And now that I know assets and liabilities, I can figure out equity, because if assets equal liabilities plus equity, assets minus liabilities will give you equity. So it's very easy to solve this problem now by simply subtracting the liabilities from the assets. So that brings us to the end of chapter 1. And I hope that you will, if you need to refer to the Red Company transactions again, that you would go through those transactions. You would solve end of chapter problems, and then you would go ahead and do the connect problems. And at the very end, you would do the practice questions to understand whether you have followed chapter 1 or not.